The interesting thing is where would you be able to park those in right now? So that is the big dilemma that we would face.
What's your biggest frustration with capital gains tax and the 1031 exchange when it comes to exiting? And what are your plans for the exit for this property?
So on this is preferred to actually go the doing what do you call that, a 1031 exchange, but just the logistics and everything behind that and getting the investor buy-in, and it would be a new process. So that would be ideal to actually defer those taxes, but is to put them in what vehicle? It would be the interesting thing is where would you be able to park those in right now? So that is the big dilemma that we would face is one, setting it up for us to do a 1031. And then secondly, where to actually put that cash.
Yeah, we call it the shotgun wedding story, right? Our parents taught us to sell high and buy low, not taught us to sell high and buy higher 180 days later with a rising interest rate and cap rates that are still pretty similar to what they were even 60 days ago. Price is very high, and you're looking at still a seller's market in many ways. And then on top of that, some investors might not are ready to get out, right? They're ready to go their separate ways. So most syndicators that we work with, like yourself, they don't do 1031 exchanges, right? In fact, they just exit and just pay their tax, and they all come back together. Now we have a cool thing called a Deferred Sales Trust. We just did it for a $48 million property in Vegas, where the two GPs exited into their own Deferred Sales Trust, and the LP did his too, and the rest of the investors just paid their tax as they normally would have. But that enables them to keep that 30 to 50% and that gain working for them, which they can turn around and put it back into their next syndication. So Sterling, having something like this that's not a 1031, that gives you that flexibility to go back into your own deals should you want to, an extra 30 to 50% to work with. What would that mean for someone like yourself who's selling 150 units right now?
That'd be a game changer. But my question is, Brett, do you have to have that plan in mind on the front end, or could you do this towards the end, and then what's the turnaround time? You have to get the buy-in, and what does that look like from the investors?
That's a great question. We call it a seamless partnership separation. So and unlike a 1031 exchange where the whole entity must move and everyone must involve, this scenario, you don't have to have anyone involved. In fact, as the GP, which you probably are, you can just assign your interest, right? It doesn't affect anyone else. And so we just had a $13 million deal, for example, in San Diego, and there was 4 partners. One wanted to just pay the tax. The other 3 wanted to do a deferred sales trust. So we set up individual
GPs.
Yeah, and these guys were all GPs in this scenario, right? And then one would have been an LP because he's just kind of more passive. He was just a passive investor. But LPs can do it too. It can be GP or LPs. Anyone can do it. And because we're not under the 1031 rules of the whole entity must move, we're able to assign interest to these trusts. So it's very simple. So Sterling can start up the Houston DST Trust as long as the buyer hasn't removed all contingencies and there's still some time left. We can simply insert the trust into the deal. And I imagine you probably own your GP in an LLC or a portion of that.
Correct. Mm-hmm.
And you can basically assign your interest to this trust in exchange for a promissory note. And that's the beauty of this, because you're changing the nature of ownership to a lender, and you're basically doing a seller carryback for the trust. The buyer gets everything he bargained for. He doesn't care. He's getting free and clear title. He's gone. The difference is your portion, let's say it's $1 million or $2 million bucks, goes to this trust, all the taxes deferred, and all of your other investors, you could just take their cash and can pay it, or they could set up their own DSTs as well. So the short answer is we do need to set it up before the buyer removes all contingencies. But as long as we takes a couple of days to set it up, of course you got to get to know us, like us, trust us, talk to our clients and all that stuff. But at the end of the day, like if it's an extra in your scenario, if you've done cost seg or depreciation, depending on what the property's at, it could be an extra 25 to 30 something percent in deferral on the gain.
Yeah, this is very interesting. I had not heard of this concept. I'm only familiar with, hey, you got to get the buy-in or you got to do it on the front end. So thanks for explaining that to me. Learn something new every day.
Absolutely. By the way, anyone can go to capitalgainstaxsolutions.com. You can build your capital gains tax exit plan where we review 1031 exchanges, Delaware statutory trust, opportunity zones, deferred sales trust. So you can create and preserve more wealth. Check out our free mastermind. Check out the new book that's coming out. That being said,